Hello and welcome to this special episode. We are going to talk about some behavioral mistakes and the most common one that many investors do, and that is related to the sector of the market to invest in. So, for instance, let's take this example where you have this March 2016 to January 2018 period. You can see the white line Nifty and the orange line is the CNX small cap. They have both run in this period, Nifty at 52%, small caps at 116%, more than double of large caps. If you were putting in more money or if you were coming in fresh into the market, would you be investing in large caps or small caps here? That is the question. It turns out that, from that point on till the next couple of years, till the COVID bottom, for instance, Nifty would have dropped 31%, but small caps would have dropped 62.8%. And when I say small caps, I mean the small cap index. Uh, so usually what is happening is that when markets are going up and there's a good trend, strong trend upwards, small caps tend to outperform large caps. You all know that. But when the market comes down, small caps actually underperform the large caps by a big margin. So if market is down, large caps are down 20%, small caps could be down 40% at that point of time. So let's take a look at few of the bull markets in the past. So the biggest bull market of the past decade is the emerging markets before the global financial crisis came, was the 2004 to 2008 rally. And you can see here that Nifty is up by almost 300% in this rally, while small caps are up 652% in this rally. Then from the bottom of the global financial crisis till 2018, we had a nice run where Nifty was up 290%, CNX small cap was up 550%, again more than double. And from very recently COVID bottom 2020 March till 2022 highs, you had Nifty going up 125%, CNX small cap going up 241%. So also almost doubling there. And now let's look at few market corrections in the past. So the global financial crisis, Nifty down 58% in this period, small caps down 77.4%. 2010 to 2013 period sideways and slightly down, Nifty down 12%, CNX small caps down 45%. January to October 2018 sideways market on Nifty, but minus 40% on uh, small caps. And Jan 2018 till March 2020, you can see small caps down 64% when large cap Nifty 50 is down only 28%. Last in this very recent 2 years, you had January 22 to June 22, small caps dropping 33% and Nifty dropping 16%. So from all these instances, you can very well make out that there is a sort of a baton which gets handed over from one to the other, and there is a distinct movement of small caps versus large caps, and we should now try to see in the current situation whether it's a good time to invest in small caps or not. For that, we will use a ratio chart. A ratio chart is nothing but one index divided by the other, for instance. So large cap index divided by the small cap index. So Nifty divided by CNX small cap is what we have taken here for the last 20 years. And you've had five distinct sort of trends in these 20 years, where the first 2004 to 2008 trend was that small caps were running, large caps were running, but small caps were running much faster. So the denominator was going up much faster. So this ratio, which has remained in the 2.2 to 2.4 on the higher side and around 1, 1.1 on the lower side, it varies between these two, so historically. Now, if in a raging bull market, if small caps are racing very hard and large caps are also gaining, but they are not running as hard as small caps, you will find that the ratio has dramatically dropped. Then in the next sort of phase, you may find that large caps may continue to rise, but small caps are not rising in this particular phase. So the ratio is moving up again. Then from 2014 to 2018, again you had a very nice push in small caps. much faster than large caps, and you have a very nice downtrend in this ratio. And then 2018 to 2020, you have virtually a crash towards the end of the period of first quarter to 2020, and large caps start to fall, small caps not falling so much, but then later small caps pick up the pace and fall dramatically versus large caps, so the ratio goes up. And since COVID bottom, we've had small caps perform much better than large caps. So you can see that the ratio has come down to nearly 1.3. Last time in 2008, we came down to nearly 1.05 or 1. And in 2018, this ratio came down to 1.1. We are about 15% away from that ratio. So what comes next? Two scenarios possible. One is that we come and retest this bottom somewhere. So another 15% or so remaining here. And if this ratio comes down, there could be many reasons why it will come down. So for instance, many scenarios can be there. The first scenario is that overall markets continue to go up with small caps outperforming large caps like they have been in the last few years. And this ratio will continue to decrease, right, till the point where it will have to turn at some point. The other scenario could be that large caps remain flat and small caps continue to rise. This also will cause the ratio to decrease. Let's look at the ratio again. So I'm assuming that we are headed here, and these are the two scenarios which can cause the ratio to go there. If I have to guess, I think the overall markets continue to go up with large caps going up and small caps going up faster. That would be sort of my bet for this particular ratio to decrease. The other scenario could be that the ratio starts to increase from here, and we've already hit the bottom, and in the next few years we again go to 2.5. And to get there, there could be three scenarios. One is that overall market remains really bearish, with small caps falling much harder than large caps, and that will cause the ratio to go up. The other scenario could be that small caps, because they have already run up in the past, they remain stagnant, and large caps continue to rally, and this will also cause the ratio to go up. The third potential is that overall markets continue to go up, small caps continue to go up, yet large caps go up much, much faster than small caps, and this ratio will also increase. So again, if I have to sort of choose, I would go with probably two or three. This is also likely that small caps, because they have reached rich valuations, may start to stagnate, but large caps, because they have not done so much in the last couple of years, may continue to rise. Or this scenario where overall global trends change, interest rates after US elections start to come down. There is a new flow of emerging market funds which come and create a gush in the large cap names. Small caps may also continue to go up, but large caps will become the focus in that kind of market, and that may also cause this ratio to increase. So basically, these are the two scenarios that are possible. We may come down a bit on the ratio and then go up, or we may directly go up from here. And all these are the scenarios that are possible. Always remember, however, that nothing is a perfect science here. These are all historical perspectives, probability based on what we have seen in the past may or may not repeat the same way. One should not make this mistake of jumping from one segment to the other. That I've made some money in small caps, now let me jump into large caps. A lot of times, a lot of opportunity gets missed. Keep your both segments alive, but maybe at different weights. So there could be a period where you may say, for instance, now that small caps have run up, the ratio has come down. Now I want to give more weight to large caps till I reach, let's say, a ratio of 2 or so, something like that. So 75-25 maybe. Uh, Once we reach 2.5, maybe you can go 25-75 at that point. Something like that is possible to do, I think. And of course, irrespective of the market, you must maintain both ends of the market. As I said that, anything can happen anytime in the market. You like for its which is very small example I can share with you. Right now, for Indian market, small caps have run up much harder than large caps. In the US market in the last few years, it has been the opposite. Large caps have run up and not the small cap. The Russell 2000 is much more trailing in nature right now versus the S&P 500. And in the India market, it is always the reverse. So everything potentially is not explainable. But if you have your eggs in both baskets, you can possibly skew the weight towards whichever market is likely to happen based on this ratio that I showed. And on top of that, we have so far been comparing indices. Indices have a tendency to, have sharp falls. For instance, small cap strategy may fall 60-70%. Large cap index also may fall 30-40-50%. But when you have strategies which are built on these indices, who are outperforming these indices since long periods of time, there is a very likelihood that you will have lesser drawdowns and you will be able to outperform both small cap and large cap indices in a very big way using these strategies. So uh, I'm showing you the index base case, but if you actually were to compare a large cap strategy and a small cap strategy, it may actually improve the situation quite a bit for your portfolio. So this is all I have for this special episode. Thank you so much for watching. Do let me know in the comments what are your views about large cap versus small cap in the market right now. What is your take on this ratio that I've just shown you? And what are your own insights as to how to play the market going forward? Thanks. Bye.